Hello, everyone. So, in today's video, I'll talk to you about India Shelter Finance Corporation, their Q3 FY26 results, and the Concall summary. But before we get into that, we'll just look at what does this company do. So, this is an affordable housing company which mainly operates to Tier 2 and Tier 3 cities, and they give loans for construction of house, purchasing of house, home improvement, and loan against property. And the kind of customers that they loan unto are generally the self-employed people, informal income household, and first time house buyers. And what they do, right? So they take this money from banks, or they issue bonds or debts, or raise capital through their equity, and then they lend it to the lend this money to these borrowers. And the difference between the borrowing and the lending, it's where they make the money, which is called the margin spread. So let's look at their results. So if you look at their AUM, it grew by 31% YOY to 10,365 crores. And if we take in terms of revenue, it increased by around 28.4% to 390 crores, and PAT was up by around 29% to 124 crores. And in terms of dispersal, how many amount that they are lending, it increased to around 11% YOY to 977 crores. And their net interest income was up by around 31% to 311 crores. And that is the main income which we need to look at it, because that's where their bread and butter comes from. And if you look at their credit cost for 9 months, it's at around 2.5, 0.5%, which is in line with their guidance for the medium term. ROE stood at 17.1%, and ROA was at around 5.8%. But the only concerning thing in this results was their GNPA numbers and NNPA numbers increased slightly to 1.5% and 1.2%. In terms of branches, they added two new branches in quarter 3, and they will add another 5 branches in Q4. And in the past 2 quarters, they've already added 33 branches overall. So if you look at the main management commentary before we get into the questions and how they answered, so we are all aware that IBI announced a further 25 bips reduction in repo rate, bringing it down to 5.25%. Obviously, this will help them because this will improve their margin and plus make it affordable for the people who are taking loan from them, because they can pass on this benefit to them. So currently, around 4 to 5% of their disbursements are coming through their online channel. And what the management is trying to say, that they're trying to increase that to around 10%. On the liquidity sides, they have a liquidity of around 486 crore as of now, and plus an undrawn sanction of around 1,300 crores. So they don't see any issue in terms of liquidity. And when the demand are there, and where's the cost, and the people who come to take loans, they'll have enough money to lend it out. And in terms of the spread, which I spoke about earlier, what they borrow and what they lend, so the difference, the spread. So it is around close to 6%, and they want to maintain it around that. So currently their spread is around 6.6%, and the cost of fund has come down from 8.8% to 8.3%. So, and the other thing we need to remember, that this rate reduction, which is done by the RBI, will not affect their overall margin. Mainly is because most of their loan book is on fixed rate. So if we all remember, right, whenever we go to banks, so either we can get a fixed rate of loan or a floating rate. So that means in fixed rate, no matter what RBI changes the rate, I have to still pay the same amount which I had borrowed earlier. In floating rate, the rate changes depending upon the rate change done by RBI. So they don't see any issue at the back of it. In terms of asset quality, the question was asked because their GNP and NNP had increased. So what they said, right? So they segregate their amount of loan that they send into certain buckets. So they have loan which they send, which they give is around below 5 lakh, then between 5 to 10 lakh, and then 10 to 15 lakhs and above. So what they're seeing, the majority of the deterioration is coming from the loans which are 5 lakh or below. And to improve that, what they have done in recent quarters, they have added around 200 collection staff to recover this money. In terms of growth, they said that in the next year, housing loan will remain at around 60%, and loan against property will be around 40%. and they're targeting an AUM growth of around 30% for sorry 30% for FY27. And in terms of branches, they plan to add another 40 to 45 branches next year. And in terms of the growth by expanding into other states, so the management said that they're already in 15 states, and these 15 states contribute to almost 90% of the total housing finance market. So they're already there in 90% where the total housing finance market is there. So they are right now not interested to move into other states where the opportunities are not that much. In terms of the cost of the fund for the next year, they're saying that they want to maintain it between around 8.1 to 8.3%. And the margin spread that they want to keep it is around 6.5%. And in terms of asset quality, they want to bring the gross NPA down to 1.2 to 1.25%. So in terms of the growth, if we see, right, the company is growing at the rate which they targeted. But obviously, the only concern is on the asset quality, because we need to understand that whenever a bank or a housing finance company lends outside, right? So even if the lending rate is growing, it's not an issue. But the challenge happens when the asset quality deteriorates, because if the asset quality deteriorates, the amount of money that they're going to receive is less, and then their provisioning increases. And at the back of it, the bottom line gets affected. So we need to see how well they are performing next year and whether the asset quality improves or not. So I'll keep you guys posted. Thank you for watching this video. God bless you.